So very good morning, everyone. Today in this session, we are going to start and complete the final concept in interest rate swaps, which is called as interest rate caps, interest rate floors, and interest rate collars. Sir, why sir caps and floors were only significantly referred here, but not the collars? Collar is a concept of cap and floor together. So there is no separate concept of collar. Having both caps and floors makes a collar transaction. Number one, in exam, there is one model of question that they are asking, rather two models of questions they are asking on interest rate caps and floors. To understand that, first we need to have a clarity on how these caps and floors are actually working in real life. Okay, for that, I have taken one question from CFA level 3 reference book called as Hull Derivatives. So all credits to that book. It is not my innovation. Actually, it was taken literally. I copied and pasted in our material by taking the question that was given from Hull Derivatives in a segment called as interest rate guarantees. Interest rate what? Guarantees. So we are first going to discuss the rudimentaries in the interest rate option, the basics, the basic preliminary understanding of this concept called as interest rate caps, floors, and collars. Okay. See the question first. A Limited wanted to borrow. This question I copied directly from there. Names I am changing. A Limited wanted to borrow after 2 months for 3 months. It is afraid of rise in interest rates. Hence, it purchases a 2 by 5 FRA MIBAR at 5%. In other words, it has agreed to receive MIBAR prevailing after 2 months in exchange for a fixed rate of 5%. This is the question they gave. Okay. From this, Hull developed the entire concept of comparison between FRA and caps, floors, and collars. So this great man in his book has first explained how this entire concept relating to interest rate caps and floors actually work in real life. It's not like a bookish understanding of how the caps and floors are working, a practical real life approach as to how these caps, floors, and collars actually work and how they differ from FRA. How they differ from what? FRA. Already FRA we discussed now. How this is going to differ from FRA is a concept we are going to discuss. Before going into that, please read this question first. Okay. So this entire video canvasses through very important aspects of FRA, interest rate swap transactions, general transactions of transformation of asset into liability, liability into asset, exchange of liability, arbitrage in swaps. All these will come again in this particular segment. So by the time a student is listening to caps and floors, it is a prima facie assumption from my side that you have already completed FRA, you have a thorough knowledge on FRA, you have already completed all the basic lectures on interest rate swap, thorough knowledge on transformation of asset liability, and then you are listening to all these. It's the assumption. If you did not complete those, doing this has no meaning. Please ensure that you completed those before listening to this, or else you will get confused unnecessarily. Read the question now. Read the question? Okay. So what is the summary of this transaction? I gave enough time for you to read the question. Now have a clarity. There is a company called as A Limited. Wait a minute. See here. There is a company called as A Limited. This A Limited 0 to 5. Okay, 0 to 5. Okay. So what happened? A Limited wanted to borrow after 2 months for 3 months. Loan expiring at the end of 5th month. We call it 2/5 contract. We call it what? 2/5 contract. So this is called as a 2/5 MIBOR. A 2/5 MIBOR. So, or technically, they wanted a 2/5 FRA contract. A 2/5 FRA contract. Who want? A Limited want a 2/5 FRA contract on borrowing. On what? Borrowing. Okay. Whenever you enter into FRA transaction, you will borrow in real life, and FRA segment will be used only for hedge purposes, not for real borrowing. Therefore, what you will do, you will have one notional principal. On that notional principal, you will enter into FRA. How FRA will be for a borrower? I told so many times when we discuss FRA. Whenever you are a borrower, think of what you are doing as a borrower. Think of what you are doing as what? Borrower. As a borrower, I am borrowing money. As a borrower, I am what? Borrowing money. Means I am getting money and I will pay the interest. I will pay what? Interest. Okay. So now borrow money means talk not in the sense of borrow and deposit. Talk in the manner of buy and sell. I will be buying money. Deposit means I will be selling money. I repeat again. I am buying money. I will be selling money. Deposit is selling money because money is going out of me. Deposit there is a sale of money. Borrowing there is a purchase of money. Though in real life we don't call them buying money and selling money. Actually the transaction nature is buying and selling. Okay. So now what we have to understand, whenever I say FRA transaction, FRA we are going to borrow. FRA we are going to what? Borrow. Okay. So what we will do, we will borrow in FRA. But when MIBOR rates are given, MIBOR will be bought and sold. MIBOR will be what? Bought and sold. Reason? MIBOR is a transaction traded not in a bank. MIBOR is a transaction traded on an exchange. Yeah. Exchange there is no buy, borrow and sell. Stock exchange there is only buy and sell. Though really we are borrowing money and depositing money, but when you express the transaction in FRA, we should not call it borrow and deposit. We should call it as buy MIBOR, sell MIBOR. Buy MIBOR and sell MIBOR. Okay. So now what we have to understand, see here. I am borrowing money. I am borrowing money. Okay. Means I am buying a selling a money. Buying. Therefore, we need to originally enter into buy MIBOR transaction. Buy MIBOR what? Transaction. We will counter it with sell MIBOR transaction. We may either get a gain or a loss. We will multiply it with notional principal. We will multiply with the term by 365. We will get the final rate of interest, which we call as the effective rate of interest. Enough up to here, understood the point clearly? Yeah. Okay. So what we have to understand, this particular company A Limited wants to borrow after 2 months for 3 months. It is afraid of rise in interest rates. Hence, it purchases a 2/5 FRA at 5%. What is 2/5 FRA at 5%? Listen carefully. 2/5 FRA MIBOR 5%. What do you mean by that? If you buy that MIBOR, you should pay something or not? You should pay 5%. MIBOR changes every day. 5% is a fixed. MIBOR is a floating rate. 5% is a fixed rate. It is just an exchange of floating with a fixed. It is just an exchange of floating with fixed. But really we don't do either floating nor fixed. Nothing we will do. Just we will knock off both the transactions, report a gain, or we will report a margin loss. Something will happen at the end. Sorry, come back to the main story now. Listen what has happened. There is a company A Limited which wanted to borrow after 2 months for a period of 3 months, entered into 2/5 FRA on MIBAR for buy contract on FRA transaction at the rate of 5%. At the rate of what? 5%. Okay. Now, listen. Now question is, MIBAR changes. MIBAR what? Changes. Because today MIBAR floating and fixed are matching with 5%. But at a later date, MIBAR will change. Even though floating rate is standing at fixed rate is standing at 5, real life MIBAR will be changing. Na? So what they will do, they said the following analysis. See, let us visualize the situation of a FRA. Okay, after 2 months, after what? 2 months. Okay, MIBAR 6%, MIBAR 5%. Let us do MIBAR 6%, MIBAR 4%. Okay, now listen carefully what we will do. First, what is our original position? By MIBAR at what percent? 5%. But what is the real MIBAR on second month end? Reversal position after 2 months. This is 0 month today, not home. 0 month. 0 month ki original position is by MIBAR at what rate? 5%. 2 months after reversal we take a reversal through sell MIBAR. We take reversal through sell MIBAR. How much percent we have taken the sell MIBAR? 6%. Now I'm making a gain or loss? Gain. Gain of how much percent? 1%. 1% gain I made. Keep it in mind. Okay. Now really answer my question. You will really buy at 5%, really you will sell at 6%, or really you will borrow at 5%, really you will deposit at 6%, really you make a 1% gain, or everything is notional. Everything is notional. That's why we will apply this 1% or notional principle. That concept we already know. Correct? Next, listen to the discussion properly. Now, I am not a speculator. I am a hedger. I am not a speculator in this question. I am a hedger. Means already I have taken a loan, borrowal. Okay, already I made a borrowing after 2 months. So after 2 months when I go for borrowing, what is the rate? 6. Ante real borrowing at 6%. But there is a gain of 2% here. Na? What is your effective interest? 5%, which matches with our fixed rate or which matches with our forward rate agreement. Is the beauty of FRA. Everyone answer. Now we saw the beauty in FRA. Let us see the beast in FRA now. Okay, always a beauty. Yeah, the beast also is there. Na? On one side, if there is a beauty, other side there is a beast also. So how it will become a beast? Let us understand. Okay, see, 0 month original position by MIBAR at 5%. Second month, when we really went for FRA closure to take a reversal sell, it was only 4%. We made a loss of 1%. We made a loss of 1%. Or I will write here 1% is outflow. Na? I am writing it as positive. Inflows we will write negative. Okay. So this is a loss. This is a loss. Now I am unhappy as a FRA transaction. I am unhappy as a party to the FRA transaction. But I am happy because really when I went for borrowing rate is only 4%. So real borrowing will be made at 5%. Real borrowing will be made at 4%. Now, what is your effective interest? Loss of 4 is a cost to me. 4% is a real cost of borrowing. Total it has become 5%. Enough understood the FRA clearly or not? So, FRA transaction la beauty enna, you will be locked at a rate irrespective of whatever happened on that day. You will be paying that 5%. Yeah, everyone understood clearly or not? Okay. Now, listen carefully. Listen carefully. This is FRA. In this, the beauty is first part. When the rising interest rates are there in the market, FRA will really help you. Okay, when there are rising interest rates, FRA will significantly help the company. However, when the interest rates are falling in the market, when the yield curve in the market is going in a parabola, if it takes a right hand turn and going down, then RBI will give the interest rate schedule. Every 3 months, RBI will release interest rate revision schedule will be released. Governor will release that with the signature of the secretary of that RBI. Then immediately when market comes to know that the yield curve rates are falling, then all the MIBAR rates will get revised on that day. How they will occur, let us try to understand at a last level. Okay, when we find time, I will discuss about those things. CFA in level 3, there is a separate discussion of a chapter called as yield curve analysis. Okay, actually they call it as a national yield curve analysis. 7-8 countries they have taken in that. India is also there. What they will do, they will ask about yield curve analysis of each country. Yield curve is a big concept in bond segment, which will be discussing about how the interest rates are going to affect the nation's economy. So how economy is going to get affected because of these interest rates, that all we have to discuss there and we need to write. Okay, sir, occasion came and just making you understand one important thing. See, recently I come across one CFA paper, latest CFA paper. Okay, latest CFA paper I came across. I saw level 2, if I am not wrong, level 2 paper I saw. One of my one of my friend who is now doing level 2, since I am doing level 3, is taking basic assistance from me. And which books to refer, what to refer, where to refer, how to study, all these things, because maybe one person is already successful in that course, means people generally will ask. So he asked what to do with that. So I said, I gave one reference book. I always follow one reference book called as a Becker's publication for exams. For exams I'm talking, not for knowledge. They will give a lot of multiple choice questions, practice questions will be given there in that book, Becker's publication. There are so many publications. I am not promoting any book here. And moreover, Becker's publication I have to buy from USA. So I'm not promoting it, but I personally follow Becker's publication. There are so many other publications as well. Beauty of the Becker's publication, what I like now, if there is a concept, for example, FRA is there. For FRA concept is there. Kaushik Mukesh cannot understand FRA because in CFA, faculty teaches 10%, student has to study 90%. CL exactly reverse. Faculty will be spoon feed for 90%, student has to prepare only for 10%. Ade CL danger is, if a faculty is very good na, student will start loving the subject. Faculty is extremely bad na, to be very frank, student will start hating the subject. Anyway, he hate the faculty first, after that he hate the subject as well. That interest is gone. CFA, the main difference is they rely more on books, less on person. CL we rely more on faculties, less on more on persons and faculty, less on books. I'm just telling the pattern. 1 or 2 students can be there who will refer books and study, but still, this is how the pattern of study is going in CA. Okay, why I'm telling this now? Becker's publication, when I used to study CFA, okay, there in Becker's, FRA concept comes, MCQ. Okay, there is a concept of descriptive plus MCQ. Essay questions will be there in CFA. Multiple choice questions also will be there. Like that, they make a proper blend of both left and right side. In that, they will give reference books also. No other publication I saw in CFA. I have somewhere around 8-9 publications at home. Every day I used to study something new. If there is anything to learn in that, I used to study. So whenever I used to study any publication books on CFA, no one will give any reference books. Means what? For example, if there is a public, I should not tell any name, so therefore I am not telling. If it is bad, I should not tell the name. That's fine. If it is good, I can tell the name. There is another book for CFA. Okay, it starts with R. That's it. Beyond this, I can't tell anything. So that book also will give questions. So many questions, exam questions they will give. But they don't give any suggested books. Reference books they don't give. Becker's is the only publication who gave that reference. I will thank him always because I have a chance to teach you. Because Kaushik Mukesh will learn from Sky, or by birth I learned about FRA, sir. Or by birth I learned FM. I should also learn from something. Na? See, anyway, faculties will not teach you, very well. So how should I learn? From the books. Okay, then at that time, I found golden types of books here. Number 1, Drury. And number 1 means I am not telling that is number 1. I am telling generally. So Drury, Hungarian, Hull derivatives, Lumbi for currency swaps, Like that, every book, every concept, one book, I started reading it. The moment I started reading it, I understood, okay, this is how really it works. And I should tell openly that CA Institute did not make even 0.5% attempt in its books to make student understand what is a swap. They started making student to hate the paper. They started making student to hate that particular segment called as swaps. Why? And phobia is created. CA final AFM swaps derivatives, you should not understand. You should not understand. Like that, a phobia is created. Why I'm telling now? It is as simple as this. In real life, swaps are going on a smoother basis than what you think. So, what is the segment? What is the conclusion I wanted to give? Rely more on your analysis and learning than relying on any other thing. Okay, wow. Here you have a chance to learn 90% from the faculty, only 10% efforts you need to put. The moment you go to any international courses, exactly reverse pattern you will see. They will come, they will say something and they will go. Your efforts should be dominating there. When it will come, here you should have guts that I can do this. Simple logic, na? Here if you have guts, na, yes, I can do this. You will do. I can't do a CNA difficult for me, na? You can't do that. As simple as that. Okay, well, let's continue. MIBAR 6, na? I told you what happened. MIBAR 4, I told you what will happen. And what you have to understand in this entire segment, FRA, there is a good, there is also a bad. There is a good and there is also a bad in FRA. What is the bad? Bad is I am forced to pay 5% even though the market rate is 4. People started getting a doubt. They became more inquisitive to learn things on this and they started making further more analysis. What analysis they have done? They said like this. Is there any instrument available in the market where if interest rate rises, I should get guaranteed rate. But if interest rate fall, I will take the falling impact. And you didn't understand that? Listen, if interest rate rises, I will take the advantage of fixed rate 5%. If interest rates are falling, I don't want this 5, I will go for the falling rates. Then people started understanding the only chance that is available is options. That's how interest rate options started in this world. Okay, options, what is the beauty here? If SP is less than AP, sorry, if SP is more than AP, if SP is more than AP, I will start exercising the option. See, SP 100, AP 120, SP 120, AP 100. Take the second case first. What happened? You have a right to buy something at 100. Sorry, first case. Sorry, you have a right to buy something at 100, which is priced in the market at 120. Something similar to this. You have a right to take loan at 5%, which is available in the market at 6%. I will exercise the option, yeah, and I will take loan at 5% only. Correct, everyone? Okay. Now, I logged myself at 5, but market it became only 4%. I have a right to borrow at 5, which is available in the market only at 4. What I will do? I will lapse and I will borrow at 4% only. Like this, I want some instrument. But in FRA, what is happening? Whether it is 6, whether it is 4, I am borrowing only at 5. I don't want like that. If it is 6, I should take at 5. But if it is 4, I should take at 4. Tell me any instrument like that. That's how they started creating the evolution of interest rate options, which are also called as interest rate guarantees, also called as interest rate caps and floors. Is that title introduction to this chapter: interest rate caps, interest rate floors, interest rate collars. Read my analysis. Point A, point B, and point number 3. The 1, the 2, the 3. So read point A, point B first. Okay, everyone? Completed? Next. Okay, third point. So you understood first to do. What if a person wanted to pay not more than 5%? There is a difference between paying 5%, paying not more than 5%. That's why I've clearly written in a different color for you to significantly understand that there is a difference between 5% and not more than 5%. What does it mean by not more than 5? If it is 4, I will take it 4. If it is 3, I will take it at 3. But if it is 6, I will take it 5. So it should not be more than 5, but it can be less than 5. But it can be what? Less than 5. So like this, if there is any instrument or not, then see. What if a person wanted to pay not more than 5? To put it another way, in FRA, the greatest disadvantage is we are locked at the interest rate of 5. So we effectively pay 5% even when practically one can borrow it 4 because you are getting a loss in the FRA segment. What if an instrument can be created in such a way that when interest rates in the market increases, we pay not more than a fixed percentage agreed. And when the interest rate fall, we pay not at fixed rate, but at the fall rate. That thought process gave rise to the evolution of interest rate options called as caps and floors. Okay. If in FRA you are taking a buy me bar, okay, in interest rate options you will take a call option on me bar because buy means call option what you will have right to buy. Here buy na, here call option. Here sell na, seller will take a put option. So you will take a buy me bar, call option on me bar. You will take a sell me bar, put option on me bar. Okay, read this. Okay. Now let us visualize the situation of a cap. Okay. So now what will happen? As I already said, after 2 months, interest rate became 6. Whatever we lock, strike price will be there na, in any option. FRA la MIBAR equal to 5% we locked. Like that, that 5% will be our SP now. SP will be 5. If MIBAR is 6%, if MIBAR is what? 6%, then what will happen? MIBAR is 6%, actual price is 6. SP, we locked ourselves at 5. AP became 6. SP less than AP, call holder will exercise. Call holder will exercise. The cap. Cap means, I'm writing here. Cap means it's a call option. Okay, I'll write technical word only. Put option, cap and floor. So see here, what will happen? SP I logged myself at 5. AP became 6. Action by call holder, exercise, because SP is less than AP, I will exercise the option. Value to the call holder. Hey, you remember now, SP, AP, action by call holder. I am not changing the schedule. I'm not changing our pattern. We will follow the same pattern. Okay, we are not going to change it. So, but what will happen? Let us try to understand. SP is a 5. AP is 6. Action by call holder. What you will do? Exercise. Okay. Value 1% is the value. Okay. You got 1% positive value. But interest rate became how much? 6. And in real life, you will borrow at 6. You borrow at 6. You get a gain of 1. Your effective rate is 5%. First point over. Okay. This is something like FRA only. Next, MIBAR. If MIBAR comes to 4, SP 5, AP 4, what I will do? I will not borrow at 5 and make a 1% loss. I will borrow at 4 only by lapsing the option. So what I will do? The action that I am going to take is a lapse. So my value will be how much? I'm not having any positive flow. I'm not having even a negative cash flow. I will borrow at 4. Now 4 plus 0, my total borrowing effective rate is 4% only. This is how people started taking advantage using the interest rate caps. Everybody understood or not? So does the company maximum pays 5%? Here the word important is what? Maximum. Maximum it pays 5%. Okay. And 5% effective interest rate on its borrowing, but can even be lower if the interest rate in the market falls. This call option ensures a cap on. This call option ensures a cap on interest payment. That means maximum cap is 5. That's why they call it interest rate caps. Interest rate what? Caps. Okay. Next. Similarly, if the company wants to deposit, if a company wants to deposit, it wants to sell money. In FRA, what we will do? When you sell, okay, when you sell, you will take a sell MIBAR original position, buy MIBAR reversal position, you will take. Correct? So, similarly, if the company wants to deposit after 2 months for 3 months and wants to ensure a receipt, okay, it can hold a put option on interest rate floors at SP of 5%. Same thing, let us see for a put option. Hey, put option holder la SP locked price should be more than AP in order to exercise because it's a selling price. So SP is, let us reverse now. MIBAR turns to 4. MIBAR turns to what? 4. If MIBAR turns to 4, okay, if MIBAR turns to 4, in real FRA, what you will do? Real FRA, what you will do? You will sell at 5, you will buy at 4, you will make a gain. Na? Same here. SP is 5, AP is 4. AP is 4. You will take a buy at 5 and sell at 4. Sorry, you will take a sell at 5 and buy at 4. You are making a gain of 1. But interest rate in the market is only 4. Now you will deposit at 4. But you are depositing it at 4%. You already have a 1% gain. Your effective rate is 5%. Is the first point. However, if interest rate becomes 6%, and SP 5, but AP became 6. Like a fool, I don't deposit at 5, I will lapse and I will deposit at 6%. I'm getting a more deposit rate. And what does it mean? This put option ensures that minimum you are going to get 5%. And a minimum, because below that it won't go. And a maximum level at which it can stand can be anything, but the minimum floor level will be 5. That's why they call it interest rate floors. That's how the name came as interest rate caps and floors. So 5% and 4% I will exercise. I will get 1% value. I anyway make a deposit at 4. Effective rate is 5%. MIBAR at 6. If MIBAR is at 6, what will happen for me? There is a great advantage for me. What is that advantage? I have a right to borrow at 5, deposit at 5, where I can actually make it 6. I will lapse and I will deposit at 6%. I will get more interest. This is how the options are going to help. Here, minimum floor interest is ensured. So it is called interest rate floors. Sometimes people will take both borrowing and depositing. If both are there, they will go for both what to say, caps and floors, then we call it collars. Then we call it what? Collars. In collar, you can have a different kind of situation. A 10 marks exam question is there. In that we are going to do 3 questions now. How many questions here? 3 questions in this. 2 are RTP questions. One is an exam question. Okay. Rights and obligations of parties in interest rate option. A holder of caps have a right to buy MIBOR. A holder of floor have a right to sell MIBOR. A writer of cap has an obligation to sell MIBOR if this fellow exercises the buy. A writer of floor has an obligation to buy MIBOR if this holder exercises to sell. Okay, read the content clearly. Read the content clearly, please. Completed? Yeah. So we have now done with rights and obligations of parties in interest rate options. Okay. Now there are 2 RTP questions. Different attempts they tested both. Okay. Similar question I have taken both. Okay. I have given the RTP questions here itself. So let's do this. I am doing totally 3 illustrations. Okay. 4th illustration I will upload as a separate segment. Just it's a question only. We have to do problem, additional problem type. Concept will be completed with illustration 1, 2, 3. Illustration number 4 also I will do and I will upload separately, such that first you will understand the concept and you can start doing the questions on your own with illustration 1, 2, 3. 4th one is optional. If you want to listen, you can listen. Okay. So 2 different videos I will upload that. Let us do illustration 1, 2, 3 and complete it. Okay. See. Suppose 1 year cap has a cap rate of 8% and a notional amount of 100 crore. Frequency of settlement is quarterly and the reference rate is 3 months MIBOR. Assume that the 3-month MIBOR for the next 4 quarters is shown below. Quarter 1, 2, 3, 4, 3 months MIBOR rate. You are required to compute payout for each quarter. Payout for each quarter. Read the question first. Okay. Now, I will explain and then I will give time for you to copy. Please listen first. Please. Suppose a 1-year cap has a cap rate of 8%. Notional amount is 100 crore. The frequency of settlement is quarterly, reference rate 3 months MIBOR. Assume that 3 months MIBOR for the next 4 quarters is as follows. Quarter 1, 2, 3, 4. 3 months MIBOR. You are required to compute payoff for the each quarter. Payoff for the each quarter. Let us understand this first. ICA has done answer this way. Question is coming on cap. But since there is a settlement quarterly, they have done in 2 ways and shown the impact. They have done as per interest rate swaps, the alternative 1, then they went for interest rate options, alternative 2, and then they gave conclusion for the answer. That's why you can expect these kind of questions for 6 marks in exam. Okay, 3 marks for your swap computation, 3 marks will be for the option payoff, and both together 6 marks they will ask a question in exam. Let us first understand what is this, and then we will go into discussion. Okay, see here. First, let us understand how interest rate swap works on this. I said very clearly at the beginning of this chapter, I am starting with an assumption that students have already completed FRA, completed interest rate swaps, and then they are listening to this. Without having that basic knowledge, this can be difficult for you now. If you can manage, you continue, or else stop the video here. Go back to my swaps. I already uploaded. Okay, go back to the swaps, listen to that, and then come to here. I will try to explain here itself. Okay, but still, if you do not find a clarity in the discussion, because I will go faster, like in interest rate swap, how can I discuss in options? So I will conclude only. I will not go to any analysis. Okay, well, let us begin. See, there are 2 parties. First of all, there is a 1-year cap rate of 8, cap rate na strike price, notional principal 100 crore, frequency is quarterly, 3 months MIBOR is a reference rate. Assume that 3 months MIBOR for the next 4 quarters are like this. Okay, in real life what happens later? Shall I explain? See, today MIBOR equal to 8. Today MIBOR is 8%. Today MIBOR is what? 8%. 1-year MIBOR. Today 1-year MIBOR is 8%. But swaps chapter what I said, because the MIBOR is a 1-year MIBOR you want, 1-year MIBOR may not be available. 180 days ke MIBOR will be stopped na. So quarterly MIBOR for 4 times they will take. So settlement happens every 4 months. Every 3 months for 4 times in a year. That's why 4 quarters ki 3 months, 4 3 12 it will complete. So settlement happens every 3 months. Okay, now listen. I want a 1-year MIBOR, but 1-year MIBOR is not available. I will go for a 3 month MIBOR for 4 settlements, such that 1 year will be completed. So what happens? Let us see. I am talking about interest rate swaps first. See here. Let us say the names of the parties. They did not give any name here. Let us name the parties. Okay, A and B. A and B. See here. A entered into a interest rate swap. A entered into a interest rate swap. Interest rate swap, what he wanted to do? He wanted to buy MIBOR at what percent? 8%. Buy MIBOR means MIBOR is coming in or going out? Coming in. So I wanted to receive MIBOR and I wanted to pay in exchange 8%. Listen, this pencil is 10 rupees. I said pencil is a commodity. Price to buy that commodity is 10 rupees. Likewise, I want this. I want MIBOR. I want a chocolate. There will be a commodity and pricing for that. Here, commodity is a MIBOR. I want MIBOR. I wanted to buy MIBOR. You wanted to buy MIBOR. Now you will buy MIBOR means you wanted to buy floating rate. You wanted to buy. Buy means you will receive it. you wanted to receive floating rate in exchange to something. You will exchange what you will give. You will give your head. You will give apple. You will give a pen, pencil. MIBAR is an interest rate, and the converse, the reverse transaction also should happen on interest rate only. Floating is transacted with the fixed rate. Floating is transacted with what? Fixed rate. So therefore, I wanted to buy MIBAR means I wanted to receive MIBAR means I wanted to pay something or not. I will pay 8% against the MIBAR. I wanted to pay 8% against the MIBAR. Shall I tell the beauty of this understanding? MIBAR is a floating rate which changes. But I don't want a change. For the floating, I will pay only 8%. That's the meaning behind the transaction. You did not understand. Swami Saranamayappa. Please again. Listen again. A, B. Two parties are there. A wanted to buy MIBAR. A will be receiving MIBAR. When I receive something, I am buying. For buying something, I have to pay something. What I have to pay? Something I have to pay. 50 rupees you will pay against MIBAR. MIBAR is an interest rate. Interest can be exchanged only against another interest. But I can't exchange MIBAR with MIBAR because both are floating only. Then why I will exchange if really I want floating? So I want floating, but I wanted to pay only fixed rate for floating. You didn't understand. I want floating, but I wanted to pay a fixed for floating. How? Same. I will receive MIBAR. I will receive what? MIBAR. And I will pay 8% for that. And I will pay 8% for that. Means what? I am receiving a floating, but for that, I will not pay floating to you. I will pay only fixed percent of 8. Even in the MIBAR is 8.8, I will pay only 8. Like that, we are going to understand. This is interest rate swap. Two parties ki swap transaction entered. Swap transaction, what happened? I will be entering into an agreement to receive MIBAR, and I will be paying you 8%. From B point of view, if you see how it look like, I will be receiving that 8% in exchange of MIBAR. How B will think? B will think I will sell MIBAR. I will sell MIBAR. Sir, I'm selling floating. I'm selling what? Floating. I'm selling floating rate of MIBAR. Na? If I sell MIBAR, something I should receive. What I will receive? Fixed rate, 8%. So A is receiving floating, paying fixed. B is receiving fixed and paying a floating. This is a transaction. Understood? This is a transaction first. So what will happen now? See the situation. See the situation. Same. I have written here. Okay, well? You have a clarity now. Okay, see here. Quarter 1, 2, 3, 4. Receiving, floating, pay, fixed, net. Observation required. See here. Quarter 1, I will be receiving MIBAR. I will be receiving MIBAR. Okay. What is the floating rate? 8.7, 8, 7.8, 8.2. This is floating receipt. Okay, but for this floating, I will not pay floating. Then 8.7, 8.7 you will pay. I will pay only fixed 8%. I am buying a MIBAR against a fixed rate. So I love to take floating, but I don't want to take a risk of floating because floating is uncertain. I will lock at fixed rate of 8. Swaps law, what will happen? You will receive 8.7 and you will pay 8. Really, you will not receive and pay. Net the transaction, you will get a 0.7% gain. 0.7% what? Gain. Next, you will receive 8%. You will pay 8%. You are not going to get anything. You will receive 7.8. You have to pay 8%. You are getting a minus 0.2 here. You are getting 8.2. You are getting this. You are getting a positive cash flow here. Up to here, understood clearly? Yeah. Same schedule. Okay, well, this is the first answer. But I will not enter into swaps now. This is option 1 that I can do. So I'm having both positive cash flows and negative cash flows. The beauty of options is This will vanish. This will what? Vanish. What vanish, sir? I didn't understand. See, what vanish na? You have a right to borrow. You have a right to borrow at 7.8, which is available at 8 na. Then you will lapse and you will borrow at 7.8. There is no question of minus. And a negative cash flows ki chance hai if it is an option. Because option, if there is a chance to come negative, you will lapse the option and you will go out. Or you will exercise and get a negative cash flow. So let us understand. Now I am going to do for interest rate options. Interest rate what? Options. Okay, listen. Okay, see. Original position. MIBOR buy at 8% means my SP is 8. Let us have a same schedule what we used in derivatives. SP, AP, action by cap holder, value to cap holder. That's it. Okay, see now. SP, AP, I hope these are right numbers. 8.78, 7.8, 8.2. Okay. Now, as a call holder, your SP should be lower than AP to exercise. Exercise or lapse, exercise. If you exercise, you will get a gain of how much? 0.7. Swaps also I got it. Second case, nullified. Third case, you will lapse and you will not get any value. Okay, no gain, no loss. And here I will get a plus 0.2 gain. What you are having in the swap, what you are not having in the cap, negative cash flows ki chance hai illa. Where if you go for interest rate options, if you go for what? Interest rate option, there is no question of negative, because if really the cash flow is going to become negative, you will lapse the option. Clear or not? This is option cash flows. This is what? Option cash flows. Okay. Now final touch. This 0.7, this 0.2 will be multiplied with your notional principal of 100 crores into 3 by 12 to get the real benefit. Okay. So the 100 crores into 3 by 12 into 0.7% one time, 0.2% one time payment. But here there is no negative, only positive receipts will be there. Other importance and significance of options. See there. Cash flow stream for caps. Sorry, first let us see this. Today, 3-month MIBOR is 8. That means MIBOR floating rate equal to 8% fixed. To buy MIBOR and to receive the floating rate, we need to sell 8%, means we need to pay 8% fixed rate. Since MIBOR represents a floating rate, it changes on every reset date and cash flow payoff is as under. Quarter 1, 2, 3, 4, floating rate to fixed rate to net. Okay, we already computed. Payoff as per interest rate caps. Payoff as per interest rate caps. Okay. Same, diagram is same, but cash flow stream, payoff, quarter, SP, AP, action, value, premium, net payoff. Premium not available in the question, therefore we did not write. If available, now that small amount we will reduce, we will get a balance there. So SP, right to borrow at the rate. Okay, AP, counter deposit. Really we don't borrow deposit. Like that we need to understand it. Net payoff in quarter 1, 100 crore into 0.7 into 3 by 12, 17 lakh 50. 100 crore into 0.2 into 3 by 12, 5 lakh rupees. You are going to get 22 lakh 50,000 positive cash flow. Okay. This concept is similar to normal options contract wherein a speculator buys at SP and sells at AP. In the same way, interest rate option, the person having a borrowing exposure will take a pay interest position at SP being a guaranteed maximum rate. In quarter 1 and 4, we have a right to pay at 8%. Even the prevailing rate is 8.7 and 8.2 respectively, and thereby making a positive cash flow of 0.7% and 0.2% respectively. In quarter 3, we have a right to borrow at 8%, which is actually available at 7.8. In this case, rather than making a negative cash flow, we will allow the option to lapse. Thus, interest rate option ensures no negative cash flow. Writer do not make any positive cash flow except premium. In this question, premium was not discussed. Okay, we have a question where premium also will be discussed. Okay, see this answer once. My explanation is completed. Your part of learning is pending. You can take a photo and write the notes later. Just for the sake of it, to understand the cash flow patterns, you can see the notes. Understood, everyone? Next question. Illustration 2. How we have taken for a cap, we are going to see the answer also for a floor in the same way. Suppose that a 1-year floor has a floor rate of 4% and a notional amount of 200 crore. Frequency settlement is quarterly with a 3-month MEVAR. I told not 2 are both RTP questions. Say different item or 2-3 items gap. They have given an RTP. First one is on cap, next one is on floor. But exam this question came first. I mean RTP. This is 2017-18 RTP or 2020 RTP like that. First put option came. Suppose that 1-year floor has a floor rate of 4. Notional amount of rupees 200 crore. Frequency of settlement is quarterly. Reference rate is 3-month MEVAR. Assume that 3-month MEVAR for the next 4 quarters is as follows. You are required to compute the payoff at the each quarter. Okay. Read the question before we go into solution. Get ready with a pen and paper. We will do it together now. Okay, let us do it together now. Write down facts. Roughly, fastly, let us do it together. Okay, next. Reference rate. MIBOR equal to 4%. Okay, that's it. These are facts. Let us do it as interest rate swaps first. Interest rate swap. But I wanted to deposit. Write down. I wanted to deposit, not borrow. I wanted to deposit. So what will happen? I wanted to deposit money. Means I wanted to sell me bar. I wanted to sell me bar. Means what? Diagram A, B. I wanted to sell a floating rate MIBOR against a fixed rate of 4%. Means I'm depositing money. I'm having a fear. Okay, whether I will get a proper rate or not. So I wanted to fix it at 4. But in return, what you are going to give? I'm going to pay you MIBOR. Previous example, I will pay MIBOR. I will receive MIBOR and pay you this fixed rate. So now I will receive fixed and I will be paying MIBOR. I will be paying you MIBOR. Okay. Now listen carefully. Really, we don't do net of love, we will get benefit. Now swap transaction, how it apply? Let's do quarter, receive, fixed, pay, floating, net position. Quarter 1, 2, 3, 4. How much is a fixed rate? 4. Roughly, let us do. How much you will pay? 4.7, 4.4, 3.8, 3.4. What are all these? Floating. So I will pay floating and receive na. Now listen. How much I will get? Receive 4 and pay 4.7 minus 0.7. 4 and 4.4 minus 0.4. 4 and 3.8 plus 0.2. 4 and 3.4 plus 0.4. Write down up to here. Okay. So 4, 4.7. 4.7 minus 4 minus 0.7. 4.4 minus 4 minus 0.4. 4 of 3.8 plus 2. 4 and 3.4 0.6. Oh, sorry, 0.6. Sorry, 0.6. So this is concept. So we are getting two negative cash flows and two positive cash flows. The beauty of options is we will turn these negative into zero. Means we are not going to get any negative cash flows. Yeah. So how the option cash flows swap. Now we are going to take interest rate floors. We are taking interest rate floors. How we are going to use an interest rate floor? Let us show. Quarter, SP, AP, action by put holder or floor holder, value to put holder or floor holder, payoff. Quarter 1, 2, 3, 4. I logged myself at 4% and other rates are 4.7, 4.4, 3.8, 3.4. What you will do as a put holder? Put holder will always exercise when SP is more than AP because SP is the selling price for him. Correct? So he will lapse, and third case he will exercise, and in fourth case also he will exercise. First case the lapse, no value. Okay. Third case I will get a plus 0.2 value. Fourth case I will get 0.6 value. Net payoff now 0. Here I will get 200 crore into 0.2 into 3 by 12. Here 200 crore into 0.6 into 3 by 12. First answer. Take calculator. 200 into 0.2% into 3 divided by 12 into 1 crore you do. 10 lakhs. 10 lakhs. Number 2. 200 crore into 0.6% into 3 divided by 12. Okay, 0.3 into 1 crore, 30 lakhs. 10 lakh and 30 lakh is the answer. Perfect. 10 lakh and 30 lakh is the answer. I'm putting it on full screen. Please see the answer. Okay. I hope everyone understood how the mechanism of caps and floors will actually work. Okay. Now, let us go into a 10 marks exam question. Question bank illustration 11. In my question bank illustration 11, this is also there in our handbook. There I did not do, here we are doing it. Okay. Even in the handbook, I have given only printed answer, but now I have given written answer. If you see my printed answer in the handbook, I have given only the main answer and some points. But here what I have done, illustration 3, the question. Okay. For this question, we made India's best analysis first. Okay. As a habit in what we will do in CFA generally, an essay answer is given, we need to analyze that. And more we need to understand the subject inside the question. So out of that, we have done a lot of analysis on this question. I will tell beyond decent level we have done. I will show you the answer first. Okay, see the case. Notes. To understand question, these are all the preliminaries. And without having clarity on this, you can't understand this question. And you know how institute answers will be. Step 1, interest flows and transaction impact. That's why left side, if you see, for our clarity and not for exams. And step 1 is only for your understanding. And preparation stage step 1. And exam you need to start directly with step 2. But step 1 is the heart and core of this entire discussion. See. That's the basic say to understand that question. Then this will start. And for exam, you need to start at step 2. Step 2 you will do. Step 2 again 2 parts will be there. Call holder and put and effective interest rate, annual effective cost. Like this we need to do. So this is all for the exams. But step 1 is our core discussion which we are going to have in the today's class. Okay. Let us first read the question. Read the question. XYZ issues a $10 million floating rate loan on July 1st, 2018 with the resetting of a coupon rate every 6 months at a LIBOR plus 50 basis points, adanana LIBOR plus 0.5. XYZ is interested in a collar strategy by selling a floor and buying a cap. XYZ buys a 3 years cap and sell 3 years floor as per the following details on July 1st, 2018. Notional principal $10 million, reference rate 6 months MIBOR, strike rate 4% for floor, 7% for cap. Premium is 0 since premium paid for cap and premium received for floor is equal. Using the following data, you are required to determine effective interest paid out at each reset date. The average overall effective rate of interest per annum. Reset dates are given for 3 years. 6 months gap they have given because 3 years cap, 3 years of floor. Reset period given. For that LIBOR rates are also given. LIBOR 6, 7.5, 5, 4, 3.75 and 4.25. One thing is pakka, 1000%. The institute has given this in exam na 1000%. They copied from CFA question. Or else why LIBOR will be given? They will give MIBOR. India la MIBOR only na reference rate. India la LIBOR rates are referred. Foreign rates are referred. And dollars. So India la dollars are traded. No. But why they have given? They have given because this is a lifted question from somewhere. But I will be happy, more than happy actually to explain these concepts. But I just wanted to tell it is a lifted question. Somewhere in I did not see this question in any book in CFA. I did not see. What is my knowledge here? 1% of entire knowledge. Remaining 99%, that 1% is doubtful. So I am a 1% knowledge holder. Balance 99% is enough, from that they will take. Everything what I saw need not be there in ICA material. I have this much knowledge. This much knowledge, I have this much knowledge. I know this part. Maybe institute also have this much part of knowledge in other segments. From there the question might have been lifted. 100% no doubt. Okay. So XYZ issues A 10 million floating rate loan. Sorry, do one thing. Read the question first. Take 2 minutes time. I will wait for you. Once you read, we'll go into discussion and final answer. Participate here. If you understand this question, no need to do any interest rate caps, floors, collars. Because this is a combination of all the three. That's why 10 marks. Read the question. Let us start. First of all, what is this question? Let us first understand the question. Then we can start the problem. There is a company called as XYZ Incorporated. Indian company first. They issued bonds. Issued a loan means what? They issued bonds to the debenture holders. Those are floating rate bonds. Means what? Interest will be fluctuating. Whenever there is a fluctuating interest, there is uncertainty. Whenever there is uncertainty, there is a risk. Whenever there is a risk, mitigation is required. Risk mitigation of interest can be made through interest rate FRA, forward rate loan, forward rate agreement, interest rate swaps, interest rate caps, collars, futures. So many things are there. We are now standing in interest rate cap, floors, and collars. Okay. So they issued a $10 million floating rate loan. Floating rate what? Loan. Who gave? XYZ Incorporated. Issued what? A $10 million floating rate loan. Issued loan means issued bonds. Worth how much? $10 million. And 100 crore, 10 million, 100 crore dollar. There in CFA they use dollar, millions, millions they also used. Okay. Reset date is every 6 months and you are locking yourself at LIBOR plus 0.5% of spread. LIBOR is the floating rate, 0.5 is the profit they are going to make. That's a spread transaction. XYZ is interested in a collar strategy. What is a collar? You will go for both the floor as well as a cap. I will explain you the discussion. Okay, I will explain you through the discussion, then you will understand. Let's read. Notional principal at $10 million. Reference rate 6 months LIBOR. Strike rate and strike price. Floor na 4%, cap 7%. Cap 7%. Premium 0. Why premium 0? I told in the previous question also not available. Why everywhere not available 0? That logic also we are going to understand now. Okay. Effective interest paid at each reset date. Average overall effective rate of interest per annum. The reset dates rates of interest given. Okay. First of all, you take options chapter, call option, put option. You take interest rate caps, floors and collars, call and put. Always observation is call value is always more than a put value. Call 7, put will be 4. There in options chapter, premium. Options premium on a call will be 7 rupee. Options premium on a put is 4 rupee, 3 rupee. Like that they will give. Why? 5 rupee call option premium, put option premium 1 rupee on the same stock for the same expiry for the same values. Why? What could be the possible reason? Reason is on the volatility. Reason is on what? Volatility. I will explain. See, SP, AP. Okay. Call holder I am talking first. SP 100, AP, let us say 120. AP 120. SP 100, AP 110. AP 110. Now listen. What will happen in a call holding? As a call holder, as a speculator, you will buy at 100, sell immediately at 120. We already discussed in options la. Everyone answer, yeah. We already discussed in options chapter. A speculative options trader will buy at SP, sell at AP. Buy at SP and sell at AP. Means what? Market la share is traded at 120. I have an option to buy only at 100 from the writer. Writer will sell me at 100. I will buy at 100. Immediately sell in the market at 20. I will make a gain of 20. Correct? Next, 110. I will make a gain of 20. I will write here. Gain 20, 10. 100, 100, 100. Everywhere 100. Yeah. This is 150. 50 gain. 160. 60 gain. 170. 70 gain. And what you have to understand here, it can go 170 can become 1000, 2000, 5000, 10,000, 1 crore, 1000 crores, anything. Means there is no limit for the profit because there is no limit for the share price in upper side. Correct? There is no limit on upper side. There is no limit on upper side. Can go to any end. That can go to extreme ends also it can go. Correct or not? So there is no limit for this. There is no cap for this. It can go to any level. 170 can become 180, 200, 400, 500, 600, 1000, 1 crore, 10 crore, 100 crore, Elon Musk. It can go to any level. When if it is a call holder, if you are a call, then the increase in price on AP can go to any end. There is no cap. For that we are putting a cap. That's why these are called as interest rate caps. So the point is there is no cap for this. It can go to any extent. 170 can become 180. Now your profit is 80. Where is the end for this profit? Your profit from 70 can go to 80. 80 can go to 1000. 1000 can go to 1 crore also. Since there is no limit, upper end it can go to any extent. Therefore, call premiums also will have higher value. Then why? What about put option? SP, AP gain. Okay. SP. When you will exercise, yeah. When you will exercise a put option, when SP is more than AP. Okay, when SP is more than AP. Sorry, see here. SP 70, 70, 70, 70, 70. AP 60, 80, 90, 120, 100. Random. Okay, now listen. Now listen. If AP is 60, you will get a profit of 10. If AP is 80, if AP is what? 80, you won't get anything. Sorry. If market price is 60, I have an option to sell at 70. I have an option to sell at 70. So I will not get any kind of gain here. Correct? I will get only 10 rupees. I will get only 10 rupees. I will exercise and I will get a gain. Remaining cases, what you will do? Remaining cases, options, you are not going to do anything. In options market, you are not going to do anything. What you will do? 80, 70, I will sell in the market at 80. I will sell in the market at 90. I will sell in the market at 120. I will sell in the market at 100. Forget about you are selling in the market at 80, 90, 120, 100. Talk about what options gave you. Options did not give me anything. Options gave me 0 value. Now you will tell, sir, you are wrong, sir. Why, sir? This also will go to any end. Like a fool, we should not talk. Whenever we talk something, there should be some sanctity for the statements made. Listen, a speculator will buy at AP and sell at SP. Buy at AP and sell at SP to make a gain. Put holder. We discussed that. No, everyone answer. So he will be buying at AP and selling at SP. Put holder. Correct. You will buy at what? 6. You will sorry. This exercise. You will buy at what? 80. Sell at what? 80. What is your gain? 0. So SP is not going to give any value to you. Sorry. Now let us understand. So no, sir. Price became 60. Now you will got 10 rupee gain. Price became 50. Then you will get 20. No, sir. Sorry. Let us see. Price can become 40. price can become 30, price can become 20, price can become 10, price can reach 0 only. It can't go beyond that. That means there is a floor for put option. That's why all puts are called as interest rate floors. The main name of the concept has been derived here. Evolution of names, there is a logic, na? Why people will say statements unnecessarily? There is some logic. When they say the word called as, floor, there should be sanctity for the word. Na? Why it is called as a floor? Because a put cannot go beyond a level. There is a floor for that. That's called as a 0. That's why put option is a floor. Call option is a cap. Now understand. My gain is 20 here. Okay, with the 70 you need to compare. My gain is 30, my gain is 40, my gain is 50, my gain is 60, my gain is 70. And my gain cannot go beyond 70. There is a restriction for my gain. When there is a restriction on my gains that is being made, why I will pay hefty premiums for that? That's why put option premiums are always less. Is the logic behind all the market tendencies today. You see any call option, call premium is always more than put premium because of these issues. 2 minutes. Okay. So in this case, I will tell you what happened. Whenever you are going for a strike price on floor, floor is a cap. Floor is a put. So therefore, 4% is the put strike rate, and 4% is the cap strike rate. 7% is the cap strike rate. I'm very sorry for confusion. 4%, I'm reading numbers wrong. 4% is the floor, 7% is the cap. 7% is the cap. Okay. Today, date is 26th April, correct? I slept on 26th April at 3:30 today. Again, woke up at 7 o'clock and I'm recording. Mind day burst. So anyway, let us have a clarity. So XYZ issues, the bonds, everything they have given. Strike rate 4% floor, 7% cap. 7% cap. Okay. This is a strike price. Locked price by us. Okay. Locked price by us. Sir, why sir premium is 0? Huh? Listen, I am taking a collar strategy. I'm taking what strategy? Collar. Collar means what? It's a combination of both put and call. Sir, put option you will receive. Call option you will pay. Same notional principal, same Libor rates, same reset date, same reset amounts. What you receive and what you pay will be same. When put is exercise, call is lapse. When call is exercise, put is lapse. Your outflows will offset each other. You will not get any gain. Then why you are doing all this? You did not read the question properly. I am a call holder and I am a put writer. See the question. I am selling a floor, buying a cap. I am becoming a call holder, becoming a put writer. Put writer will have a transaction of buy, call holder also will have a transaction of buy. Both are buy transactions, but how we are going to apply that significant discussion in this particular segment. Okay, va? Listen. Sorry, sir. Okay. So you are taking a put writer position, call holder position, correct? Yes. What a call holder will do, have an option to buy. What a put writer will do, put writer has nothing to do unless and until put holder takes a position. If put holder exercise to sell, put writer has to buy. Means I'm a call holder, I will buy. I'm a put writer, I will buy. Call holder has an option to buy, put writer will have an obligation to buy. Both are not same. Both are not what? Same. But one discussion you need to understand. When put holder exercise, put writer will buy. When put holder exercise, call holder will lapse. So in both cases, I am not going to buy. You may now get it out. Sir, sir, 2 times you will buy. Mind, we have to use na. Mula illena, we have it. So how to understand? As a call holder, if you exercise and buy, as a put holder, that other party will lapse. As a put holder, if other party lapse, as a put writer, we don't have an obligation to buy. That's why options, you should have full grip to understand this interest rate options. Again, I'm telling you are taking 2 positions as a holder of a cap and as a writer of a floor. And you are a call holder and a put writer. You are a call holder and a put writer. As a call holder, what you are going to do? You have an option to buy. When a call holder exercises on something, on the same thing, put holder will lapse. When put holder lapse, put writer will also lapse, because put holder ke lapse anyway, not there put writer ke. If he lapse, my value will be 0, nothing. I don't have any kind of buying. So as a call holder, if you buy, as a put writer, you need not buy. As a put holder, as a call holder, you are not buying. As a put writer, you will buy. So you will buy only once, but there is a concept of caller, a beauty we are going to understand. But what is the assumption in this question? Na? As a call holder, what you will do? As a call holder, what you will do? As a call holder, I will pay premium. I will pay premium. As a put holder, put writer, what you will do? I will receive premium. Just now I told you, call and put. In both of these cases, premiums will not be same. Call premium will be more, put premium will be less. And if I pay 5 rupee, I will receive only 2 rupee like that. Correct? But in this question, they took a weird assumption. A CFA person might have taken this assumption. Our person, first copy, later we will discuss. First copy. So premium 0. Why premium is 0? Premium is 0 because they are saying that call premium and put premium offsets each other, which will never happen unless and until option is an American option. Option is a American option. American option has a convertibility concept. In our CA syllabus, American options are not there. We have only European call options. But there is a concept of American option. That's why they have given a company in USA and currency in dollars. Institute lifted this question directly from some CFA material, but they did not understand the intricacies in this question. In India, we don't have American options. We have only European call options and put options where premium can't match. American options, the chance is there. They took that assumption, logical. India, why we will take that assumption? Yeah, but still don't question ICA. Don't question the question also. So take it as it is. That's why what they said, premium on cap and premium on floor, both are same. ICA is telling, yeah, when God himself is telling this is what it is, we should hold hands and say, okay, that's it. Call premium, put premium, both are same. Question discussion over. See. Cap is a call option, floor is a put option. If a person takes both the position at the same time, we call it callers. Here in the given question, XYZ Incorporated is interested in a caller strategy with the following parameters. Institute suggested answer you see for the question. Nothing they explain. Direct answer. Student won't understand. They will brand chapter as difficult, but very easy. See there. Not to pay more than 7% on borrowing. Cap. Not to receive less than 4 on your deposit. Put. Notional principal. 10 million. 10 million, 1 million. 10 million. And 100 crore rupees. 100 crore dollar. Strike price. Call. Cap strike price is 7. Floor strike price is 4. Cap premium, put premium offset each other. Option duration 3 years with half yearly reset. Okay. Read the facts. 1 minute time. Read the facts. Okay. Now, see, step 1. Step 2, 3 we can do together. Step 1 only listen. Okay, those who are listening now, just you can take a screenshot or something like that. Beyond that, you need not do anything, but follow properly. This is important discussion. Okay, for our clarity and not for exams. Interest flows and transaction impact. Interest flows and transaction impact. Okay. First, let us understand what we have done. First, XYZ incorporated with the lenders or debenture holder. So, bank or someone. So, first, XYZ, our company, borrowed from a lender and agreed to pay the LIBOR plus 0.5. LIBOR is the floating rate, whatever may prevail at the end of 6 months, every 6 months. 0.5 is the profit spread they added. Original transaction. Next, XYZ, our company, also taken a call holding. Also taken what? Call holding. We are holder. Okay. We are holding means we are going to pay. We are going to what? Pay. I am already paying which rate? Floating. I don't want it floating. I want fixed. I want fixed. What you can't do in the real world, do it in the dream world. A dream world, a swap world. Okay. So what we are going to do, since you can't pay fixed in the real life, pay it in the swap. But here we are not doing a swap. We are doing a options. So therefore, what I will do, LIBOR plus 0.5, now what will happen? LIBOR plus 0.5, there is no limit. LIBOR, if it is 8, it will become 8.5. LIBOR 10, it will become 10.5. LIBOR 20, it will become 20.5. Namaste, I don't want that. Real life, I already did a wrong. Okay. Real life law, already I did a wrong by making a floating rate bond. By taking a floating rate bond, in real life, I already did a mistake. Rectify that in the swap market or rectify that in the options segment. How to rectify that? Do one thing. You wanted to pay in fixed, but you have taken already floating. Na? In options, you take fixed. In options, you take fixed. Net effect, you will get a fixed. How? We will show that. Okay, listen carefully. Therefore, there is a writer. There is a writer. Let us say it's a banker. Okay, writer. This person is ready to swap the transaction now. What we have done, I said, I will buy a 7% cap. I will buy what? 7% cap in exchange of a LIBOR. In exchange of what? LIBOR. Means what? Normally, I am paying LIBOR. Okay, but I wanted to pay fixed. To pay fixed, you will pay 7%. 7% against what? Against an exchange for LIBOR. Therefore, you will receive LIBOR and you will pay a cap. Forget about what is happening to LIBOR. You think only about cap. What is happening? Cap means what? Call. Call means what? Right to buy or right to pay. Like that you can understand. I wanted to pay fixed. So therefore, you take a cap. Okay, you will tell that I will pay 7%. I will pay 7%. And you will have hefty premiums now. To adjust that, I took a call put writing position also. If I take a put writing position, what is the advantage? What is the advantage? As a call holder, if you exercise, put writer will lapse. As a put writer, you will exercise. As a call holder, you will lapse. Then what will happen? I will pay only once, but the premiums will offset each other and I will have a zero premium impact, full profit say, no negative cash flow. So now what will happen? Let us see. XYZ, holder of a cap. XYZ wanted to pay fixed. So I have to take a cap. I took a 7% cap and I agreed to pay 7% to the writer. Depends. Now I also took a put writing position. Put writing. XYZ is a writer. XYZ is a writer. Writer means I have an obligation to buy. Obligation to buy means obligation to pay. I will pay 4%. I will pay 4% and I will receive LIBOR plus 0.5. Beauty, let us understand now. Beauty of this concept. I will receive LIBOR plus 0.5. Okay, I will receive LIBOR plus 0.5. Okay, ma? I will receive LIBOR plus 0.5. I will receive LIBOR plus 0.5. I will pay LIBOR plus 0.5. I will pay LIBOR plus 0.5. What will happen? I will receive LIBOR plus 0.5. I will again receive LIBOR plus 0.5. Real life, I will pay LIBOR plus 0.5. This and this will cancel. So net what is happening? I will receive LIBOR plus 0.5. Okay. I will pay either 4 or 7 or in between. Floor is 4, cap is 7. I will pay somewhere between 4 and 7. Between 4 and 7. LIBOR, let us say it is 3%. 3.5 plus something in between is your effective interest rate. That's what we are going to show. In this question, do you know what is the main significant thing that we need to understand? We are locking ourselves at a rate not higher than 7, not lower than 4, because premium I wanted to offset. That's why I have taken a 4% floor, 7% cap. I can guarantee tell that my effective borrowing rate will not be more than 7 and not even less than 4. Let us see how it works. Okay. This is all what I explained. You can read it later. Okay. Now, directly I will come here. Directly I will what? Come here. What if? Hey, all explanation. I don't write all these in exam. This also I will share the notes in our group. Okay, in Telegram group I will share. In WhatsApp group also I will share this notes. You read the notes properly. Whatever I said now, I have given here. Okay, I see pay premium, receive premium will offset each other. I told now all these things. Okay, net impact is what? We won't pay more than 7. We won't pay more less than 4. So we are controlling our volatility between 4 and 7. Here, okay. So let us try to complete this first. What if LIBOR is 3% on maturity date? What happens if the LIBOR is 3% on maturity date? If you understand this problem become dead easy. What if LIBOR become 3% on maturity date? What will happen? See, I will do as 3 cases, because you are a real borrower, you are a call holder, you are a put writer. We have to see all the 3. As a borrower, I will pay LIBOR plus 0.5, 3.5. As a call holder, what you will do? As a call holder, we have a right to pay at a maximum rate of 7. As a call holder, let us see. LIBOR means what? The actual price. So SP, you locked at 7. AP, 3.5. You will lapse. No need to pay to the writer. No need to pay to the writer. Correct? And as a call holder, you are not going to pay anything to writer. You will lapse it. Value is 0. No profit, no gain. As a put writer, SP4, AP 3.5. SP4 and AP 3.5. What you have to understand here? SP4, AP 3.5, na put holder will exercise. So if LIBOR is 3% on maturity date, what will happen? I will really make a borrowing at 3 plus 0.5%, 3.5%. As a call holder, what will happen? My SP is at 7. I have an option to buy interest at 7, but which is available only at 3.5. I will lapse. No need to pay the writer. As a, and this is lapsed, this contract is closed. As a put writer, put holder, let us see. Put holder ki SP is 4, 3.5. He has a right to sell interest at 4, which can be sold in the market only at 3.5. He will exercise. and he will get a gain of 0.5. I should bear that loss. My loss is minus 0.5%. We need to pay. So we need to pay 0.5% on net payoff to the writer. So here, what is my effective cost? Here 3.5, here 3.5 net effect 3.5 plus call value 0, and here 0.5 net effect 4% is our maximum, sorry, interest rate that we are going to pay. When if LIBOR is as low as 3, next, if LIBOR is 5%, if LIBOR is 5%, as a borrower, your borrowing rate is 5.5. As a call holder, SP7, AP 5.5, you will lapse. Why you will lapse? You have a right to buy at 7, which you can buy only at 5.5 in the market. You will lapse. Okay, you will lapse. Okay, now, and 5.5 you already borrowed now here. Next, as a put writer, what will happen? 4 and 5.5, put holder, let us see. Put holder has a right to sell at 5.5, which can be sold only at 4% with the writer. He will lapse. I will get 0 value. Now, what is my effective rate? 5.5 plus 0 plus 0. Both sides I am lapsing the option. Okay, 5.5 is my net interest. At a 4% in 3% case, 5%, 5.5% in 5% case. No, sir. If LIBOR goes to 8% on maturity date, then what will happen? Real borrowing becomes 8.5, very costly. Okay, now I have a right to buy at 7% only. I will exercise and I will get a gain of 1.5%. 1.5%. Next, as a put writer, he will lapse 0 value. The benefit, the cost, net benefit will be 8.5 minus 1.5. 7% is the maximum rate. You take any number, it will be between 4 and 7 only. That's the beauty of this particular question. This all institute they did not give, and you need not even write this in exam. This is for your understanding, clarity. Okay, what is the impact of this collar transaction I gave you now? Okay, 7% is your net. Hence, it is proved that in no case it will be more than 7 and less than 4. It will be between 4 and 7. It's a collar. It's a cap, floor, between the collar is there. Okay, next. Step 2. From here, exam answer starts. Payoff table and effective interest rate. See, they have given multiple rates. What are the rates here? 6, 7.5, 5, 4.5, 3.75, 4.25. Okay. Always remember one thing. Always remember one thing. Whenever you are entering into call market and options market, spread will not be added. This is LIBOR rate. This is LIBOR rates. LIBOR plus spread you should not. Spread will be added by banker. Options are traded on stock market. Stock market don't have a spread. Na? So LIBOR rates we will compare. Okay. So there are 6 reset dates. 31, 12, 18, 6, 19, like that. 6 months gap. 6 reset dates are there. All 6 dates. My SP is common. Call option. We are talking about call holder. 7, 7, 7, 7, 7, 7. APs are changing every 6 months. 6, 7.5 like that they are changing. See, SP should be lower than AP to exercise. Higher lapse, higher lapse, higher lapse, higher lapse, higher lapse. In this case, I will exercise and I will get a gain of 0.5. Up to here, clarity, va? Okay, see, I have a right to buy interest at 7%, which is available in the market only at 6%. I will lapse, value is 0. I have a right to buy interest at 7%. Okay, I have a right to pay interest at 7%. Okay, which I can pay in the market at 7.5. I will exercise and I will get a 0.5% benefit. Third case, same logic has to be applied. Put writer, let us see, 4%. Okay, put writer SP should be more than AP to exercise. Less lapse, less lapse, less lapse, less lapse. Exercise on lapse. Next one, more you will exercise. I have a right to receive 4%. In the market, I can receive only 3.75. I will get a gain. Who will get a gain? Put holder will get a gain. Put writer will get a loss. Put writer will get a loss. Okay. Remaining none. Net effective interest. This schedule you can see in your study material answer also. Do you know what happened? 10 marks question. This is the question. Okay. First, we analyzed the facts understanding. Next, we went into interest flows and transactions impact. Then we went into understanding the payoffs at each interval, 6 months interval we understood. Then lastly, we are doing this. Institute answer you should see. Then you will understand the importance of our class. Direct or schedule. This schedule. How they have done. See, reset dates are given. 31, 12, 18, 19, 19, 20, 20, 21. 6 reset dates. Actual rate. Actual rate is a banker's rate where spread also will get added. Okay. So spread added. 6 becomes 6.5, 8 becomes 7.5 become 8 because LIBOR plus 0.5. Okay. Days. Half year na. Listen, this is important. 30/12/2018. 31/12/2018. Okay, see. This is a reset date 31/12. For this, we need to take from the 1st June. 1st July. April, May, June. 3 months over na. April, May, June. Over 3 months. Correct? Okay. See here. There are 6 reset dates. There are actual rates. Days are also given. This is the reset date on 31/12. Okay, 31/12, which we will be counting from 6 months before. Okay, means from July 1st to 31st December, this is the rate. This rate will be fixed on 1st July itself, but actual payment will be made after 6 months. Hey, interest will be fixed today. You go to the bank, you ask for a loan. What is the interest? They will tell, I will tell after 5 years, they will tell. 5 years, what is the interest rate? They will tell today, but you will pay after 1 year, 2 year, 3 year, 4 year, 5 year, like that. So fixing date is 6 months back. Reset date is after 6 months. And this 31/12/2018, this rate was fixed on 1st July. So count the days clearly. Day count convention important. July 31, July, Jan, February, March, April, May, June, 6 months over. From July, you have to count it. Okay. July, August, September, October, November, December, 6 months. So July 31, August 31, September 30, October 31, November 30, December 31. 184 days. 184 days. So take calculator. Actual interest to the bank. How much is the loan? 10 million. How much is the loan here? 10 million. 10 million 100 crore. How much? 100 crore. Okay, 100 crore into 6.5% into 184 divided by 365. Okay, 184 divided by 365. So calculate the number and tell me. See, here I have given clearly 10 million 1 crore. So I said 100 crore, sorry, 1 crore. 1 crore into 6.5% into 184 divided by 365. 3,27,671. 3,27,671. First case, when the percentage is 6.5, lapse in call, lapse in call, lapse in put, both are lapse, dash and dash. Your net effective cost is 3,27,671. 36/2019. Take calculator. Jan 31, February 28, March 31, April 30, May 31, June 30, 181 days. Okay. So how to calculate? 1 crore dollar. 1 crore dollar into 8% into 181 divided by 365. 3,96,712. 3,96,000 what? 712. What is this? This is an actual interest you have to pay. But when it is 8%, there is a cap benefit. There is a cap benefit. Cap benefit is there. Not 8. Here, these are all actual rates. That's why whatever written actual interest is calculated on LIBOR plus 0.5% basis, and it is calculated as principal borrowing, real borrowing, into LIBOR into 3/365. This is for the real borrowing. See, this column, this column, this column, real borrowing. This is not real borrowing. This is stock market, cap and floor, traded on exchange. Okay, these two transactions, exchange happened, we should not take the spread. So how to calculate cap benefit? 0.5 you got the benefit, correct? So how to calculate? See here, 1 crore into 0.5% into 181 divided by 365, 24,795 benefit you got. So you have to pay 396,712. You will get 24,795 effectively this much. Same we have done also for the put option. Directly see the put option for that case. Minus 0.25 you have to pay. Put right now you have to pay. Already you are paying 214, 247. Again you have to pay 12,603. Totally 226,850. So total interest is how much? 16,63,700. 698. Don't round off. Okay, 16,63,698 is the total interest on what? 1 crore. For how many days? 365 days. Per annum we have to calculate. Na? So per annum if we calculate, this is for 1096 days. 365 days effective rate is 5.54. What is the promise that we made? Your interest rate will be not more than 7, not less than 4. It is 5.54% in this case. Okay, this is how this problem has to be solved. Hopefully everyone got the full clarity on interest rate caps, floors and collars. Okay. Thank you.